You're in the Business Insurance Zone with me, Steve Savant, national insurance columnist and financial color commentator. And today on The Biz, we're talking about Guaranteed Universal Life from our Competition Desk series with Brandon Roberts, Insurance Pro Blog Extraordinaire.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I am Steve Savant, your host, and we're broadcasting live to a nationwide audience of financial professionals right here in Fountain Hills, Arizona, home of America's largest fountain. And thinking about a home of America's largest fountain, we have at our guest home in our house today, one of the largest insurance bloggers and article writers in the United States and an expert in almost everything that is competitive intel in life insurance, Brandon Roberts. Welcome to our show, Brandon.
Good to be here.
Day two. Hey, listen, yesterday, I know we're going to take some heat for the spreadsheet cheat thing. Well, it had to be said. What can I say? If you think yesterday was kind of somewhat controversial, and I thought we were nice about it. I didn't think we were nasty or anything. But today we're talking about Guaranteed Universal Life, and I want to kind of take on from yesterday's show, that last segment, again on maturity dates. We're talking about how long people are going to live. I can only tell you that the pricing of Second to Die back in the 20th century was really, we were way off. We did not get the claims we thought we were going to have because women live forever, by the way. Women just live forever. When we talk about durations, we have it's a potpourri of periods. It could be anywhere all the way down to 85, all the way out to, I think AG's out at 131, and then we have carriers that we talked about yesterday that aren't even putting a date. It's life of the insured. Now, and you brought up yesterday, they're already doing actuarial science calculations. They're already doing modeling where you don't die. I don't know how do you sell life insurance? That guy that's not going to die. I mean, did I miss that? Or I know, to me, that's amazing. But here's the thing. They always tell us that we are field underwriters. That's our moniker. Back in the day when I came in, they didn't call us an agent. They said we were a field underwriter. And part of that was because we were asking questions about their health, a client's health, talking about their family history, talking about their medications, and we were schooled back in the day. They actually taught this young people. They actually taught us how to underwrite out in the field. So we would be doing our underwriting and we'd say, we think the client's going to be this. Of course, back in the day, you were either a smoker or non-smoker, so there's not much to underwrite. So, but today, we're talking about our ability not only to have a little bit, we need to up our game on the physiology issues, but here's the real point. We're now given the authority. Remember, this is the carrier. So if we get in trouble for this, I'm putting the onus back on the carriers. They gave us the flexibility to dial the death benefit. So Brandon, let's talk about that because there's the yin and yang about this. That's good, sometimes good, but sometimes it can be horrible. Talk about that.
It's the rope of freedom, which you can hang yourself with. Yeah. It really is a matter of if you're going to go out and tell these people it's permanent death benefit, you need to go beyond all realm of imagination when it comes to mortality. If you're dialing it down so that you can be a little bit under the next guy, you're just driving down to the bottom. You're not doing anybody any favors. And if you're not telling somebody that you're doing that, you're really screwing the pooch on that one.
Well, I think most of the public, when they think Guaranteed Universal Life, I don't think they're looking at age 90 or whatever we're writing on the application. I think when they hear Guaranteed Universal Life is a permanent contract, they're hearing the word forever. Now, am I making a mistake in that?
No. Absolutely not.
I'm just talking about the consumer understanding.
There's plenty of people who look at it and think, okay, it's guaranteed, it's got to go on forever. There's a lot of agents who think, okay, it's guaranteed, it's got to go on forever. So sometimes they don't even know because their back office is saying, well, we'll compete a little bit better with this if we're at 95 or 94 or something like that. So that's what we're going to go with.
If we're shaving the timelines, I mean, out of thin air, we're just saying, hey, we're just going to drop it so that we can compete on the spreadsheets. We're doing a huge disservice to our practice, the industry, and of course, I think we're really hurting the consumer here. So let's talk a little bit about when we're talking about underwriting. Let's just stay right now. At least, I don't think there's anybody's going to debate, hey, if you have a substandard case, this thing should be going on. You might want to look at maybe 90, 95 then. If this guy's table 4, I can kind of get that, right? You're going to tell the client, you really shouldn't be like, but heads up, the exponential curve on medical advances right now is huge and fast. It's like accelerator on the floor. So I say, well, you're table 4 today, but who knows the drug management issues, and we've only gotten better. I remember back in the day, any male cardiovascular event, pretty much deep 6 to case, that was 25 years ago. This is so not the case now.
Right.
Talk a little bit about this kind of thing.
Exactly. There are lots of advances that have taken place in the underwriting world. And if we just take a second and look at it, we can realize, certain conditions that would have made you decline or rated years ago get you standard or standard plus offers. So if that is reasonable, the sheer math behind this says they're sitting on numbers that says we can make people live longer. And if they're going to live longer and you're going to sell something like GUL where it's really death benefit and you're looking for money when you die, you really don't get to play, well, I'm going to assume that you'll be dead by such and such an age.
Well, I'm concerned because we really made guaranteed UL. We actually, this is Steve's little fantasy. I think we made this in response to giving a longer term insurance coverage, and so that we could say, likened unto whole life premium, that we had guarantee all the way out. Now, when I think about guarantees on whole life, I never flinch on this. I just know, hey, here it is. It's guaranteed to age 100 or whatever. They don't let us dicker around. There's no mechanics. There's no adjustment. There's no fine tuning. It is what it is. I like the flexibility if it's in the hands of the right planner, if it's in the hands of the right advisor.
Right.
So I'm always confused about this issue of death benefit. I'm wondering, from a strictly death benefit point of view, if I look at all that's available out there, starting, I think I can dial it down to pretty much a 15-year spread or age 85, whichever comes first, all the way out to 130 something, and again, a couple carriers that don't even put a mark on it. I think that what we've come up with in our national study group is a really good rule of thumb. And if you say, Steve, I need to know that rule of thumb. I mean, you guys have really looked at this. We live this, right? We breathe this all day long. We blog on this. I'm trying to get Brandon into starting to tweet, tweet with me, because we think this is really an issue, and we want to really up your game, keep you compliant, and make sure you're treating the consumer really well. When we come back, we're going to talk more about guaranteed universal life. We're going to talk about the accumulation test and the infamous shadow accounts that go with it. When we come back, we'll also add to you what we think is some of our remedies to correct some of the things we've been talking about.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Companies in our business are always touting service, products, and underwriting. And we do that too. But here's the difference. Now enter the world of the elite producer with a value package that cuts us out of the pack. A BD that approves social media marketing of non-FINRA products and doesn't take an override. With the best competition desk in the industry, and for our loyal producers, a true group health plan. No one offers that. Brokers Alliance does.
Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant. I'm with Brandon Roberts, one of the top bloggers in the United States on life insurance from Insurance Pro Blog. And we're talking about guaranteed universal life, which, by the way, then makes me nervous because now I'm going, well, is it guaranteed?
Right.
When we talk about guarantees, and I say this in a statement, this is the title and definition of the product I'm talking about, then why is it that we're having controversy between the New York carriers that do business in New York, who are parking major money in their reserves and are doing the accumulation test, one issue, and everybody seems like outside New York, we're doing these things that kind of sound spooky, like the shadow accounts. Talk a little bit about this.
There's two things that have happened. One, underwriters were allowed for a while to create these shadow accounts that basically said, we're going to assume above target funding, and we're also going to assume much higher than what we know to be market interest rates. And some of them were up in the 10% range, which is high.
Wow.
And that is what allowed the product to sort of stay afloat. Knowing that the premium itself was probably not going to build the reserve that they needed, but in the background they had this thing running and that was working. And that was okay in terms of reserve requirements because insurance companies started to go out and grab letters of credit deals with banks. And there are two new pieces of actuarial legislation, AG 30 and AG 38, which has caused a lot of confusion because people don't quite understand what the rules are, what the ramifications are, but what they believe is that, first off, the letters of credit are not going to be available like they thought they were. So the only people who are really being able to sustain guarantees that they wrote are people who just reserved it, which almost no one did.
Well, except for your New York probably reserved it, right?
Well, now they are with principal-based reserves. They're forced into that situation where they have to have the reserves available to do it.
Well, makes me slightly nervous, I have to say, because if I'm sitting there considering the idea of shadow accounts being really priced thinly, right to the edge, and any downward move of interest rates, which we've been experiencing for the last decade, it could cause problems. And now, I remember in the old days when we first came with a guaranteed UL, I had catch-up provisions, right? If I fell behind, I didn't pay the guarantee, I could go ahead and do all my back premiums, pay a little interest, and I'm back up on the guaranteed. Everything's ready to go, and I'm done. But on these shadow accounts now, I cannot do that.
And now all of the mutuals or anti-GUL companies are shouting from the rooftops the idea that maybe this product that was supposed to be guaranteed isn't guaranteed like we thought it was.
Yeah, wait a minute now, because this is where I get really nervous. If our guaranteed universal life, just the moniker in the name has the G word in it, and if I find out that it's not guaranteed because I have shadow account deficiencies because they use an accounting method to create shadow accounts so that they could actually reserve less, which cost them less to price the product, and now I don't know if I have a guaranteed premium, and if I'm 1 day late, I can get charged more. What's with that?
The really, really good news in all of this is we have to remember that all life insurance contracts are unilateral contracts, so they're all contracts of adhesion. So any ambiguities in these contracts will rule in favor of the insured because they don't get to stipulate any of the
Now, the contract of adhesion, explain that a little bit.
Okay, so contract of adhesion is whenever you enter a contract, you can either have both parties negotiating terms, or you can have just one party stipulating terms and the other party accepting it. That's what's going on with life insurance. That creates a contract of adhesion. What happens is if there is a dispute over how the contract is supposed to work, and so it has to have a legal opinion rendered on it, because it's a contract of adhesion, the assumption has to go in favor of whatever benefits the party that did not get to stipulate the terms. So theoretically, we're assuming that if this really gets to critical mass and people are coming back and saying, wait a minute, I was told guaranteed, but it's not. The good news is we'll probably be able to bring suit out that will keep coverage in force. The major headache and the shot to credibility is going to be to the agents that went around selling this as guaranteed and then have to explain that, well, we got to go to arbitration or we got to go to court to keep the guarantee in place.
Well, I'm just certain of this, that if there's contractual triggers tied back to the shadow account deficiencies, and we have to go back to the client with bigger premium billing on this is going to cause a fiasco. I've seen 2 or 3 carriers now that have already entered into this conflict, and we have seen them, they'll never see the light of day on arbitration because they know the PR alone would be disastrous. So they're settling now. Now, another thing though, I always thought I had 30, 60 days to pay my premium. It gave me a little grace period to pay it.
Traditionally, under SNFL, the standard non-forfeiture law.
Is that what it's really called, SNFL?
SNFL, that's how I refer to it.
Okay, there's a new one for the business insurance zone, SNFL.
Which varies state by state, but products that have a non-forfeiture benefit, which would be a cash value component, are supposed to, in most states, have a 60-day grace period, where if you do not pay the premium, you've got 60 days before the non-forfeiture piece kicks into play.
All right, but which premium? The premium that I was told, the guaranteed, or now I have a new one because I didn't pay exactly on time?
And that's where we get back into the contract of adhesion that says, well, we would probably assume that everybody would reasonably believe it's the premium that they received on page 2 or 3 of their policy that said pay this and coverage is in place until age 120, 105, whatever.
Well, I think this is really a huge issue, and we're looking at all of our, believe you me, after this came out, Steve Savant is looking at a lot of our contracts. We're trying to find out everybody that's playing in the shadow account market, what their response will be, especially with the 60-day free look. We want to know so we can bring comfort. We're trying to head this off at the pass before we run into real problems. I think if you really look at this and study it, and I hate to say it, it bothers me, the New York actuaries probably were right. Unbelievable. Well, that's all we have on The Biz today. You'll be able to watch this show and all our shows at www.brokersalliance.com. Just hit the red button. Well, that's the Buzz on The Biz for today. See you tomorrow.
The Biz is brought to you by Brokers Alliance, a national leader in insurance products, support services, and educational workshops. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.